The world is at a crossroads, and the financial industry is no exception. As we navigate through an uncertain economic landscape, there is one looming threat that cannot be ignored: the possibility of a bank crisis. A bank crisis is a term that strikes fear into the hearts of people around the globe. And for good reason. It can bring about a catastrophic impact on economies, individuals, and businesses alike. If we fail to take heed of the signs of a potential bank crisis, we risk being caught off guard and suffering the consequences. History has shown us the devastating effects of past bank crises, from the Great Depression of the 1930s to the more recent financial crisis of 2008. It's crucial that we take steps to prevent another such catastrophe from happening. This is not a topic that can be taken lightly. The banking industry is the lifeblood of our economy, and any disruption in its functioning can have serious and long-lasting effects. We cannot afford to turn a blind eye to the signs of a looming bank crisis. In this video, we will explore what a bank crisis is, the signs that suggest a potential crisis, the potential consequences of a bank crisis, and steps you can take to protect yourself. It's time to be informed, aware, and proactive. Join us on this journey to uncover the truth behind the looming bank crisis and learn how to prepare yourself for the worst. What is a bank crisis? A bank crisis is a tumultuous event that rattles the foundations of the financial system. It's a situation where banks are unable to meet the demands of their customers, leading to a domino effect of financial turmoil. Such crises can arise due to a variety of reasons, ranging from economic recessions to fraud and mismanagement. Bank crises are not a new phenomenon, and history is replete with examples of such events. One of the earliest and most significant was the Panic of 1907 in the United States. It was triggered by the failure of the Knickerbocker Trust Company, leading to a cascade of bank failures and runs on banks. The effects of a bank crisis can be far-reaching, affecting not only the banking system but also the broader economy. Banks are the backbone of the economy, and a crisis in the banking sector can lead to a credit crunch, a fall in economic activity, and even a recession. The causes of a bank crisis can vary, but some of the most common include a sudden loss of confidence in the banking system, high levels of debt, and an increase in the number of non-performing loans. In addition, fraud and mismanagement can also contribute to a bank crisis. To understand the impact of a bank crisis, it's important to look at the consequences. In the short term, a crisis can lead to bank failures, a contraction of credit, and a liquidity crunch. In the long term, it can result in a decline in economic growth, rise in unemployment, and a loss of confidence in the financial system. Signs of a looming bank crisis. As we enter a period of economic uncertainty, it's important to keep a watchful eye for signs of a potential bank crisis. There are several indicators that suggest a looming crisis, and it's essential to be aware of them. One of the key signs is a sudden increase in the number of non-performing loans. These are loans that have not been repaid, and they can be an early warning sign of trouble in the banking system. If the number of non-performing loans rises rapidly, it could be an indication that the banking industry is under stress. Another sign to look out for is a decline in the profitability of banks. If banks are struggling to make profits, it could be a sign that they are taking on too much risk or facing challenges in the wider economy. A sudden increase in the level of debt in the economy is also a warning sign. When debt levels are high, it can be difficult for banks to manage their risks, and it can lead to a buildup of financial imbalances. A decline in the value of assets held by banks is also a sign to be wary of. If the value of assets held by banks starts to decline rapidly, it could be an indication that the banking industry is under stress and that a crisis may be on the horizon. Finally, changes in regulatory policies can also be a warning sign. If regulators start to tighten their policies, it could be an indication that they are concerned about the stability of the banking system. Potential consequences of a bank crisis. A bank crisis can have far-reaching consequences that go beyond the banking sector. If left unchecked, it can cause significant damage to the wider economy and to people's lives. Here are some of the potential consequences of a bank crisis. Firstly, a bank crisis can lead to a credit crunch, which is a sudden tightening of credit availability. This can have a severe impact on businesses and households, making it difficult for them to borrow money for essential purchases or investments. A credit crunch can cause a ripple effect across the economy, leading to a fall in economic activity and rise in unemployment. Secondly, a bank crisis can lead to bank failures and the collapse of financial institutions. This can result in a loss of people's savings, pensions, and investments, causing significant financial hardship for individuals and families. The failure of large financial institutions can also damage confidence in the financial system, leading to a loss of trust in banks and other financial institutions. Thirdly, a bank crisis can trigger a liquidity crunch, which is a shortage of cash in the economy. This can make it difficult for businesses to access the funds they need to operate, leading to a decline in economic activity and rise in unemployment. Fourthly, a bank crisis can lead to a recession, which is a period of prolonged economic decline. A recession can be caused by a combination of factors, including falling economic output, rising unemployment, and a decline in consumer confidence. It can take years for the economy to recover from a recession, and the effects can be felt for a long time. Finally, a bank crisis can lead to social unrest and political instability. When people lose their savings, pensions, and investments, they can become angry and frustrated, leading to protests and demonstrations. This can create a volatile political environment, making it difficult for governments to govern effectively. Steps to protect yourself. While a looming bank crisis can be a cause for concern, there are steps you can take to protect yourself and your finances. Here are some strategies you can implement to safeguard your investments and savings. Firstly, it's important to diversify your investments. By spreading your investments across different asset classes and industries, you can reduce your overall risk exposure. This means that if one sector or asset class performs poorly, you'll have other investments that can help mitigate the losses. Secondly, it's wise to keep an eye on your bank's financial health. Stay informed about the bank's performance and financial position by monitoring its financial statements and credit rating. This can help you identify any potential red flags early on and take appropriate action. Thirdly, consider opening accounts with multiple banks. By spreading your deposits across different banks, you can reduce the risk of losing all your money in case of a bank failure. Make sure that each bank you choose is financially stable and reputable. Fourthly, it's important to have a contingency plan in case of a crisis. This could include having emergency funds set aside or considering purchasing insurance to protect your investment. Having a plan in place can help reduce your stress levels and give you a sense of control in an uncertain situation. Finally, seek the advice of a financial professional. A qualified financial advisor can provide you with expert guidance on how to protect your investments and safeguard your finances during a crisis. In conclusion, the looming bank crisis is not something to be taken lightly. It has the potential to cause widespread damage to the economy and people's lives. While it's impossible to predict exactly when and how a crisis will occur, being aware of the signs and taking proactive steps can help mitigate the risks.